Okay, let's get started. Thanks, guys, for joining. As I've mentioned in the past, this is an initiative to try to figure out how to rerun these programs, kind of remotely, given the pandemic. So you guys are kind of assisting in giving me feedback on how this works, how the platform works, whether you know it or not. Thank you. I'd also encourage, tell as many people as possible, because the more people you can, I can see, the more feedback I get. I'm recording these. And, I'm also writing a new book on Amazon. So I'd love your feedback, or building the model on Amazon is going to help me figure out, and your questions on it is going to help me figure out accurate reporting. So I'm looking forward to these courses. Let me know if you're okay with the pace. Please just send me an email. So today we're going to continue to build down the income statement. And if you recall, last Monday, we spoke about laying out historicals. And with the income statement, for the most part, every company is going to have a revenue line item. And I'm first kind of opening what the core income statement structure should be. So let me just step back for a second. What's going to be different about building a model on the income statement versus other statements is the income statement is we want to pull out some line items that might not be reported, or they're on an annual report, because there are some line items that we use as financial analysts that are not required to be reported on an income statement, like EBITDA, right? So with an income statement, when modeling an income statement, there are some adjustments that are going to be made. Every company, you'll see a revenue line item. So we've looked at that. Every company is going to list expenses. Not every company groups expenses into two tiers, and we need that. Those two tiers are costs of goods sold versus other operating expenses. And the importance of having cost of goods sold is so we can create the gross profit metric, which is revenue less cost of goods sold. Not every company is required to report gross profit. Gross profit is good for analysis, though. The reason why we want revenue less expenses is to show EBITDA, earnings before interest, taxes, depreciation, and amortization is arguably one of the more important metrics for analysis. That's very important. And we're going to zero in on that now. So jumping into what we've built so far, we've built the revenue, and we've laid out revenue into two line items because Amazon has done that. So we just did what Amazon has done. Let me just pull up the actual financials in the Amazon report for reference. When you get to the Amazon financials, they just list all the expenses in one big bulk, which is commonly often the case. Walmart does the same thing. By the way, if anybody has the book on Walmart as for a second perspective, I strongly recommend to look at modeling that because Walmart's done a little bit different, and it'll help you get more of a perspective as to how sometimes these line items differ and how to handle them respectively. Here you go. So they have revenue and two line items. So we just laid it out into two separate line items, just like they did. Then they have a bunch of expenses. And we said, okay, for us, we're just concerned about separating the expenses to two tiers, cost of goods sold and OpEx. And they have laid out cost of sales, which most companies do. Cost of sales, cost of goods sold, same thing. So we separated that, cost of sales. We built our margins, and then we laid everything out into the second tier of expenses called operating expenses. Okay. Fulfillment, technology and content, marketing, general and administrative, other. Okay. Laid that all out. We added them up. Each line item we looked at as a percentage of revenue, because those metrics, which is a margin metrics, technology and content as a percentage of revenue, marketing as a percentage of revenue, are helpful in making financial projections, which we're going to talk about later. Then we have EBITDA. EBITDA is technically gross profit minus OPEX, or earnings before interest, taxes, depreciation, and amortization. So this is the earnings before depreciation and amortization is removed, before interest is removed, and before taxes is removed. Okay, so in order now to build from EBITDA down to net income, we have to subtract the components of EBITDA. So we need to subtract out depreciation and amortization to get from EBITDA to EBIT. We then have to subtract interest to get from EBIT to EBT. Then we remove taxes to get from EBT to E. E is earnings or net income. So we say, okay, let's pull out depreciation and amortization. Now, if you look at this income statement, you'll realize, which is often the case, it was also the case with Walmart, I don't see a line for depreciation and amortization. So this is the first strong example of how we need to re-represent how a company has laid out their financials. Now, this could mean two things. This could mean that the company does not have depreciation and amortization. Now, depreciation and amortization is a very common tax deductible expense. I highly doubt the largest company in the world, one of the largest companies in the world, does not have depreciation, but we have to prove it. So it could mean that it's truly zero, or it could very well mean, which is often the case, that depreciation and amortization has been reported within one of these other expenses. So we as analysts need to find out where it is and take it out so that we can truly report EBITDA. So it's a little tricky. How do we find out? We got to go look for it. This is where it's important to have these statements handy and the notes within the statements. Now, this is where you guys can help me for whatever reason. I know you have this annual report. I used to be able to just Control F and search a PDF. I don't know why I can't. I guess I'm getting old. I can't search. I used to be able to go depreciation. It doesn't find anything. Well, okay, I spelled it wrong, but I've tried this a million times. Depreciation. I don't know why it doesn't look in the document. It says it has further search in the document, no matches. No, but I know that's not true. I don't know why. I don't know if it's this version of Adobe that I have. It just sounds crazy, but it cannot. Maybe these tables have been put in as pictures. Well, it even can't even find it in the notes. The searching has been very difficult, so I had to go through the daunting task of just scrolling through and trying to uncover it. Now, one trick to find if depreciation actually exists is to look at the cash flow, because although a company sometimes combines depreciation within an expense in the income statement, for several reasons we can talk about, they actually list depreciation explicitly in the cash flow statement. And guess what? Here it is. Depreciation and amortization of property and equipment and capitalized content costs, operating lease assets, and other. There it is. So we know they have depreciation. We can use these numbers unless we find better numbers. When I say better numbers, sometimes they actually have a depreciation table. I have not found one, or I have not found it yet. We might uncover some things. Again, this is the process of an analyst's annual report. You build what you know, highlight things, and as you go on, as you dig deeper and build the model and the model gets bigger, you'll uncover some other notes and items where you say, oh, so that's what that means. Let me go back and adjust. And you slowly build your model bigger and better. So what I know, at least for the beginning, is I can use these numbers for depreciation. So let's do that. 11,478 for 2017. Okay. 15,341 for 2018. And 21,789 for 2018. Now, did I cheat here? I cheated. Okay. You notice these numbers changing because I've already jumped ahead and put in a formula that we're going to talk about. So one thing to note, and it's already happened. I wanted to walk you through this, but I had forgotten to remove this formula that we were going to create together. But the formula's in there. Okay, so I'll talk about it. Now I put this depreciation expense in there. That depreciation expense, though, is already in these numbers, right? So the next step is if I put this depreciation expense in and don't do anything else up above, I'm going to have numbers that are different that's reported in the annual report. Because what we're trying to do is we're trying to separate depreciation out from up above. So when I put these depreciation numbers in, I have to now figure out in what expense line item were those depreciation numbers? And I need to remove those from above. How do I figure that out? This becomes difficult. And I talk about it in a lot more detail in the books, and I'll talk about it in a little bit of detail here. But the idea is you kind of have to read the notes and read between the lines. Sometimes it's pretty explicit. Sometimes they say, our depreciation and amortization expense is reported in cost of goods sold, for example. Okay, then great. Then you take 11,478, then you take 111,934 and you subtract it from 11,478. Very simple. Sometimes it's a little vague. In reality, which is where this becomes complicated, there's a little bit of depreciation and amortization everywhere. And that is probably often the case of why depreciation expense isn't explicitly separated out anyway. Sometimes there's a little depreciation in COGS, a little depreciation in SG&A, a little depreciation in other, and you'll almost never, I've rarely seen details broken out of which portion of depreciation and amortization is attributed to each. So what do you do? What we do as analysts, and what I do, and what I recommend in the book, is to remove it from what you believe most of the expenses in. You'll not get everything. And so you might think, well, but then that's not accurate. But this is where in analysis and reporting, you kind of have to make guesstimates or estimates. And you have to think about, well, where am I going with this analysis? And so what should give some peace of mind is if, let's say, depreciation and amortization is spread out between fulfillment and technology and content. And let's say you accidentally took it all out of fulfillment. Well, guess what? Your EBITDA number is going to be 15 million, let's say. If you accidentally took it out of technology and content and not fulfillment, guess what? Your EBITDA number is still going to be 15 million. My point is, it doesn't really matter where depreciation has come out of up here, because as long as it's been removed up above, you are creating EBITDA. And that is the most important number for our analysis. So analyst on the job lesson, and I'm going to have many, is it is very important to have close attention to detail, but some things you will never find answers for. And it's very easy for an analyst that has the mindset of everything's got to be 100% accurate to get stuck. And you have to think about, well, I can dig and try to find out whether depreciation is in fulfillment or technology and content, but step back and think about it. It doesn't matter. As long as you're pulling it out, you're still going to get EBITDA, right? You're still getting accurate EBITDA, which is the most important thing. You'll still have accurate gross profit. So, guys, can you hear me? I want to make sure you guys can hear me. Okay. So somebody is asking about sound. Okay, so it must be, I don't want to single you out. Must be on your end. Just double check your, okay. So how do we at least make a reasonable estimate? Okay, how do we at least make a reasonable estimate? You got to go through the notes. And I found several notes, scrolling down. The first thing I went to is the explanation of expenses. So right after, here's the notes to the consolidated financial statements. This is where they give you an explanation. So they say, description of the business. Okay, well, I really want a description of revenue. Okay, cost of sales. I quickly scanned to see, does it include depreciation? And actually, when reading this, purchase price, consumer products, this is really the cost of, they are buying products and reselling. Doesn't seem depreciation related. Fulfillment, payment processing costs. So I went to the next one. Fulfillment. This is one of the major operating expense costs. Okay. Just a reminder to mute your microphone, and side note, you are welcome to unmute and verbally ask a question. Okay. Somebody asked about the 2017 25249 should be right in the income statement. I'm going to go back to that in a second. Maybe I typed it in wrong. Let me just kind of finish this thought here, and I'm going to jump back to it. Fulfillment talks about buying, receiving, warehouse inventories, costs associated with seller transactions. Doesn't sound like depreciation. Let's jump to technology and content. Okay. They talk about infrastructure costs, networking equipment, data center related depreciation and amortization. There's the first instance of depreciation and amortization. So there is at least some depreciation in technology and content. Going to hold that. Maybe it's there. Marketing and advertising generally does not consist of depreciation. Depreciation is the wearing of assets, fixed assets, intangible assets, usually not marketing and advertising. General and administrative could have some depreciation. Well, actually they do. So, okay, great. So here's one thing. So general and administrative. Now, general administrative usually does consist of some depreciation. They talk about it. Now, tricky part within general and administrative is if you look at their general and administrative of 3 million, our depreciation of 11 million, depreciation is much bigger than 3 million, right? So hold that thought. Right now, we've seen notes about depreciation in technology and content or general and administrative. Last one is operating expense. Operating expense is very, very tiny, so I don't think it's in there, but maybe. Let's see. They don't even talk about it here. Sorry. Other operating expense includes marketing-related, contract-based, customer-related, intangible asset amortization. So it does. Okay. So right now, and I'm first going to remove this. You don't have to do this, but just for illustration, I put a formula in here. I'm just going to remove this formula because I was supposed to remove this formula before sending it to you. We're going to put it back in a second. Okay. So this is our financials, right? So right now, we found notes of depreciation included in technology and content, selling, general, administrative, and other. Namely, some asset amortization in other, and then pieces of depreciation in the other two. How do we divide it amongst the three? There's no further breakout, and this is where this gets complicated. Okay, so my point is this: you could maybe make a percentage estimation if you want, right? You can take a pie and say, well, this is 1% of the pie of these three items. This is 90% of the pie of 3 items, and spread it out. You could. I rarely see that done because the point of depreciation is as long as it's removed from total operating expenses as a whole, you are achieving your goal of creating proper EBITDA. All you want is EBITDA. So you can have it 100% out of technology and content, and you've removed it from total OpEx. You can have it 90% here, 80% here, 10% here. It's not going to change your EBITDA number. Where it might become a little tricky is if depreciation and amortization was also mentioned as being in cost of goods sold, because it would impact your gross profit numbers, but it's not. Well, it doesn't say at least. So what I said here is, all right, let me just remove it from one of these line items, knowing that it's going to make the same impact to my EBITDA number. And because 11 million is much greater than OpEx, much greater than SG&A, and it's smaller than technology and content, I removed it from technology and content. I chose technology and content as the biggest bucket of those three. Make sense? So what I did was, this was originally a hard-coded 22620. I went into 22620. This you already have in your model. I went subtract minus 11478. I went to the 28837. I went minus 15341. I went 35931. I went minus, and you can go in and say, Paul, you know, I'd rather make a side table, EBITDA breakout, take a percentage of each line item. Great. Great. To me, and again, this is an item that I spoke last week about being a smart analyst, being a good analyst. This is one of those items where you highlight it, go to your associate, and you say, you know what? This is the way I handle EBITDA. I simplified, I lumped into technology and content. Would you like me to break it out as a pie? And he will probably likely say, nah, it's overkill. Or he might say, you know what, that's good. Do that analysis. Great. As long as you've identified that, good analyst. Okay. So we have EBITDA. EBITDA is going to be very valuable for our analysis. Now, somebody had a question up back and I neglected it. I'm sorry. Okay. Ming, thank you very much. I was afraid of that. Interesting. Okay, so it's something with the report where it has, right, so it's not properly searching for those characters. And thank you for going back to 2018. That's a good thought. I didn't even think about that. Going back to the 2018 report that doesn't have the same issues. So Ming is saying that the 2019 report has some character issues. And so the search function isn't it's not really looking for it's searching for the letters I'm typing in, but the report hasn't been, I guess, PDF'd properly. Okay, so for the 2017, oops, something's popping up here. For the 2017, for the 2017 25249, hang on, the 2017 25249, we got, I'm going to go back to the annual report to the actual income statement so I can show everybody. I believe it's accurately in there. I could be wrong. There it is, 25249. That's the fulfillment. Okay. 2017. Are you asking because you only showed 2018 to the 19? If that's so, you might have pulled up a different report, interestingly enough. So there's depreciation, okay? As far as we know. Now we can get EBIT. Let's do this together. EBIT very simply equals EBITDA minus depreciation. Copy to the right. Remember, copy to the right? Highlight the cell of the formula that you want to be copied to the right. Hold down shift. While holding down shift, tap to the right twice. Let go of everything. Big Control R. Copy right. Oh, interesting. Now, did I make a mistake here? Interesting jump on EBIT from 2017 to 2019. Seems unusual. I know what's happened. I know what's happened. Good. I already caught a mistake. So I need better depreciation. This depreciate good. See how EBIT analysis, well, there's also a significant jump here. I know. Yep. Same mistake. Same mistake. Yeah. See, okay. Good. So, let's try to turn this into a positive because I made a mistake. See how I kind of caught a mistake by just stepping back and thinking about high level. This doesn't make sense. This is quite a jump in EBIT. This is 300%. 300% from here to here. It's tripled. This is quite a, this is another 20% increase, jumping from 18 to 19. What's happened? I'll tell you what's happened. And I said to myself, okay, well, is there any typing error? And I looked at these numbers and I said, okay, well, were some of these items jumping too quickly? And I said, yeah, look at depreciation jumping too quickly. You know what mistake I made? Anybody catch it? You wouldn't have caught it unless you've been an analyst before, or unless you've done analysis before. The mistake that I made, and we will learn about this soon, is in the cash flow statement. Hang on. Actually, no. I don't think this is a mistake. I had thought that the depreciation was accumulating. It might not be. It might not be. Look at their cash numbers. They're rising as dramatically. Let's look at their income numbers. Okay, never mind. Hold on. Let me give myself a little more credit. Let's look at this 4, 12, 14. No. There's, okay. Operating income matches 4, 12, 14. Okay, no mistake. I thought this was climbing too fast. I thought I made a mistake in the depreciation numbers, but I guess not. And yes, sanity check, of course. Although they don't have depreciation reported, their operating income is going to match our EBIT. And it does. Good sanity check. Never mind. No mistakes. Okay, next. They have, we want to get from EBIT to EBT, or here IBT, earnings before taxes, income before taxes, same thing. We got to remove interest expense and other. And what they have from their EBIT to IBT is they have interest income, interest expense, and other income expense net. Other income is a common line item that's reported after EBIT. Other income. Sometimes other income is separated out into a section, into several line items. I talk in detail in the book about other income, what other income can be. I'm not going to talk about it so much now because it's pretty simple in Amazon. Other income is often a line item called equity in earnings of unconsolidated affiliates. What that means is a big phrase, which means if this company owns pieces of other companies and those other companies report income, those companies owe this company income. So if this company owes, running out of time. Okay, I want to start to make these sessions longer, guys. I'm going to start to get an upgraded subscription. If those companies offer, so if this company has investments in other businesses and those other businesses produce a return on those investments, that return is income. So this company reports that income as other income. So what I want to do for the sake of time is let's punch those numbers in. Other income, 346, 346. Okay. Oops, 346. Okay. 183 and 203. Minus 183. And do it exactly as they did it. And 203. Okay. I highlighted it red because we're going to talk a little bit more about this next week. The question on this is, where should it be? And, you know, I put it above interest. They have it below interest. That doesn't matter. The real question is, should it be part of EBIT or EBITDA or not? Very important way to think about things. I want us to open up next class talking about that, okay? What I do want to make sure we get down is interest. Okay. Interest income. Oops. And interest expense. So they have interest income as 202,440,832. Okay. They have interest expense 848,147,1600. Now, one other interesting thing I got time to talk about real quick is, for whatever reason, oftentimes when you get under operating income, the reporting changes the logic. Above, every expense is a positive, shown as a positive number. Now when you get down here, all the expenses are shown as a negative. Why? It's so confusing. Now I got to think that through. Okay, I'm now under EBIT. Now an expense is going to be negative. So now when I calculate my formulas, my pluses are going to be minuses. That's confusing. I like to change the signs and make things consistent. Every expense is shown as a positive number. So interest expense is going to be 848, positive 848. Okay. That means interest income, reverse logic, they showed it as positive income. If every expense is going to be a positive number, I want income to be a negative number then. I'm going to make that minus 202. So that when I make net interest expense, I can easily sum the two together. Net interest is equal to interest expense plus interest income. That's the net. Again, I know it's confusing, but with the exception of revenue, every expense here is shown as a positive. And it's always confusing for an analyst to look down here and to see the signs have changed. What I'm doing is now saying, I'm going to keep one simple logic. The exception of revenue, every expense has a positive number. Down here, they changed the logic for whatever reason. I'm going to make my easy logic. Every expense is going to be a positive number. So every income, with the exception of revenue, is going to be negative. So I'm going to make this plus 848 because it's an expense, minus 202 because it's income. Also then, I'm going to go down here and change the signs because other income, positive, I want my logic, and expense to be positive. So I'm going to make income not 346, but minus 346. And so this 183 is going to be plus 183, and this 203 to be minus, okay? I'm changing the logic to be consistent throughout. We're going to talk all about this next class. So this is plus 1417. This is plus because it's an expense, 1600, okay? And this is, flip the signs, sorry, minus 440. And this is minus 832. How do I know I'm right? Well, to get income before tax, I can just continue to subtract down. If I went with their logic, I'm going to have to add something, subtract something, so confusing. I'm going to continue to subtract down. EBIT minus other income minus net interest expense. 3806. Does that match? 3806. It matches. I flipped the signs, but the logic to me is simple. 11261. 13976. Saving this. Okay. One quick thing here is I highlighted this red. The numbers are in there, but it's a little confusing. Let me highlight this yellow. There they are. Okay. You just can't see it because the format function has negative numbers in red. So there they are. Okay. Everything I've done, I've made a comment here. Okay. So guys, lesson here is continuing to build down, being able to build out, separate out depreciation and amortization. Next, a little bit more difficult lesson is what to do with other line items. Why is other income after EBIT, not before EBIT? We're going to talk about that next week. We're going to continue to build down to earnings before shares. And we're going to talk about making projections on the income statement. Okay? So guys, I have this recorded. Great class. Please give me your feedback. I know some of you have. Let me know if you think this timing, This frequency is okay. I said, I know one gentleman asked if we can push it back. I haven't figured out the ability to push it back 1 hour on my schedule. I don't know if you want to meet a couple more days a week, 2 days a week, 3 days a week to move faster. I'm happy to. If you want longer sessions, we can do longer sessions. Send me an email. Let me know how things are going. This is where we're at. I'm going to email this to you. We'll talk more about the income statement on Monday. Thank you all for your time. Please tell your friends. The more people I have, the more interest I get, the longer I'll run these courses, the more excited I'll get. So please tell your friends, and I'm going to send out this model and look forward to the next class. Okay, guys? Thank you very much. All right, guys. Thanks for the notes. If you want to just email me too, just to give me your feedback after, feel free. Have a good week. See you Monday, and we'll take it from there. If some people think 2 days a week, please give me a suggestion as to what second day would be better. Would it be Friday? Would it be Saturday? Would it be a weekend? All right, guys, be in touch. Thank you.